Analyzing properties and knowing whether or not they're good deals is a critical part to becoming a successful real estate investor. And while you can use rules of thumb to get a quick read on a property, at the end of the day, you'll need to run a full analysis to determine whether or not you should actually purchase that property. And in today's video, I'm going to walk you through the 4 steps you need to take to quickly analyze a rental property. Hey guys, my name's Tony J. Robinson, and I'm the co-host of the BiggerPockets Real Estate Rookie Podcast, and I've analyzed hundreds of properties using the exact same method I'm going to show you today. Now, there are investors who might have their own unique approach for analyzing a property, but I'll share what's been working for me. So the very first step in analyzing a rental property is to determine the potential income. If a property is vacant, then you'll want to determine what the current going rate is for a property of that type. Now, you can find this data pretty easily using resources like Zillow or Craigslist, and BiggerPockets even offers a tool called BP Insights, which makes finding rental income super easy. If the property is currently occupied, then you can simply use the current rental amount. Quick caveat, if the current rent on that unit is far below market rents and you'll have the ability to raise rents once you take over the property, it probably would be a good idea to bake that increase into your analysis as well. One other thing to note is that some properties generate income from things other than just the rents that tenants pay. You may be able to charge for additional storage or a parking spot if it's a multifamily property. Or maybe you can offer additional services like snow removal or a trash valet service. There are all kinds of ways to get creative and generate additional revenue for your property. So just make sure you're capturing all of those additional streams of income as well. Okay, now that you've got your income, it's time for step 2, which is identifying your property's expenses. There are several expenses, and it's important that you capture all of them. Otherwise, you may end up overestimating how well that property will perform, which, believe me, could put you in a bad situation. I did that with one of my properties where I didn't include the flood insurance, and now we're doing everything we can to sell that property. The first expense you want to account for are property taxes, and you can find this data in a few ways. Zillow provides tax estimates, which is a good place to start, but you can also go to the local county assessor's office to find more specific property tax information. The next expense is the insurance cost. Now, this is honestly pretty easy to get. Just reach out to an insurance agent and ask them for a quote. And if you're unsure of which company to go with, ask your real estate agent or your lender, and they most likely have someone they can recommend to you. The next expense you want to account for is the property management fee. Now, you might be thinking, hey, I plan to self-manage, and that's totally fine. But even if you plan to self-manage, it's always good to still include this as an expense so that later, if you decide to hire a property manager, you don't end up losing money on that property. Now, property management fees will vary by the market and by property, but somewhere around 10% is probably a good figure to use. If you really want to dial this number in, then maybe call up a few property management companies and see what they actually charge. The next expense is utilities. This is another one that will vary because, some landlords have tenants pay all of the utilities, while some landlords cover a portion of their tenants' utilities. You can ask the current owner what their current utility expenses are, or ask some other investors who own properties in that same market to get a ballpark of what you can expect to spend. Now, quick side note, I've heard some investors use this strategy, but sometimes you can just call up the local utility company and say, hey, I'm thinking of purchasing, 123 Main Street. Can you tell me what the, historical utilities expenses have been? And sometimes they'll be willing to share that information with you. So your next expense is your mortgage cost. Now, you can plug in your purchase price, down payment, and interest rate into pretty much any mortgage calculator on the internet to figure out what your monthly payment will be. And things like your interest rate, you'll need to get that from your lender, but the purchase price and the down payments, you can probably figure those ones out on your own. Now, your next expense is your vacancy cost. Now, it's highly unlikely that your property will be 100% occupied for the entire time that you own it. At some point, you'll have a tenant leave, which means the income will drop to 0 while it's vacant. So you'll want to set a little bit of money aside every single month to make sure that you don't have to actually pay out of pocket when that vacancy actually occurs. Now, a general rule of thumb is to set aside somewhere between 5%, maybe 10% of your income towards vacancy. But again, this will vary a lot by the market. So my recommendation is to speak with the local property manager to better understand occupancy rates in your area. Now, for example, on my first couple of long-term rentals, I knew that I could set aside a little less for vacancy because the normal kind of lease terms in that market were 24 months, whereas most leases, they're in the 12-month range. So knowing your market will help you understand how much money you should be setting aside for vacancy. Repairs and CapEx are the last and final expense. Things are going to break inside of your property. It's bound to happen at some point or another. Sometimes it'll be something small, like a light fixture, or maybe a small section of the drywall needs patching. Other times it's going to be something big, like needing to repair the roof or buying a new AC. Just like your other expenses like vacancy, you'll want to set aside some money each month so you have reserves in place to cover these expenses when they happen. Now, really quick, before we move on to step 3, I have one small favor to ask. If you're enjoying this video, please subscribe to our channel. We promise to keep pumping out super helpful content just like this, and be sure to hit the little bell. That way you get notified every time we release a new video. Okay, so the third step is to subtract your expenses from your income. This is the fastest step, but it's also the most fun because here's where you get to see how much money you'll actually make in profit from this property. Now, again, to get that number, whatever dollar amount you landed on for your expenses, just subtract that from the rental income, the other income that you calculated, and voila, you've got your profit number. And now for the fourth and final step, it's time to calculate your returns. The most common number you see new investors use to determine the strength of an investment is the cash on cash return. And that's what we'll focus on in today's video. Now, there are other metrics like cap rates, a bunch of other ones that I won't get into because this channel is mostly for the rookies. And I think cash on cash return is probably the easiest one for you guys to understand. So the cash on cash return tells you what kind of return you're generating based on how much money you invested into the deal. So let's break down how to calculate that number. So you'll take your annual profits and divide it by how much money you initially invested into the property. And your cash on cash return is usually, almost always, expressed as a percentage. Now, to keep things interesting, I'm actually going to share the numbers that I ran on my very first investment property. This was a single family home in the city of Shreveport, Louisiana. I estimated that the monthly rent for this property will be about $1,500 per month, and I came to that number based on conversations with my property manager and what they felt the property was worth. Step number 2 is identifying your expenses. Now, let's run through the expenses that I identified for this property. First step were property taxes at $132. Then insurance was $104. My property management fees were $100 flat. I had $0 in utilities because the tenant paid everything. And then the principal and interest payments were $861 per month. Now, based on my property manager's knowledge of the market, he recommended a 3% vacancy because people in that specific market, they don't tend to move all that often. It's a very kind of heavy renter's market, and when people find a good place to live, they tend to stay there for years. The last expense is repairs and CapEx, and I put both of those around 3% as well because we fully rehabbed this property before the tenants moved in, so I knew we'd be able to hold off on most of those repairs for a while. And at 3%, those both came out to about $45 per month. That brings our total monthly expenses to $1,332. And when you subtract that $1,300 give or take from our total income of $1,500, you end up with a net profit of $168 per month. Now, I know that's not a huge number, but you've got to start somewhere, right? So to figure out the annual profits, you take your monthly profit of $168 per month, multiply that by 12, and you end up with $2,016 in profit per year. Now, I actually invested $0 into this deal because I was able to use some creative financing. But for example's sake, let's say that I spent $20,000 to acquire this property. So we'll take $2,016, divide that by my $20,000 investments, and that gives me an 8% cash on cash return. Now, I really encourage you guys to head over to BiggerPockets.com and check out some of their calculators because it makes it really, really easy and straightforward to analyze properties just like the example that we went through today. And the more repetitions you get, the better you'll become at analyzing properties. So thanks for hanging around with me until the very end. If you guys have any questions about the 4 steps that I just went over, then drop them in the comments below. Now, also, if you're not subscribed to this channel, make sure to hit that subscribe button and the little bell to get notified every time we drop a new video. We publish videos every single week with content just like this to help rookie investors like yourself succeed in starting their real estate journey. I will see you guys in the next video.